stock valuation example problems, the ones that we talked about in class. So I'm going to run through 4 different types of models, the zero, the constant, and the varying growth dividend models, and then I'll talk about the free cash flow model. So the Simplex example for stock valuation is looking only at dividend payments and assuming that dividend payments do not change. So the first example is, let's suppose Walmart pays a dividend of $2.04, is expected to pay a dividend of $2.04 over the next year. Let's say the risk-free rate today is 1.5% and Walmart's risk premium is 2%. So the challenge is to compute Walmart's stock price, assuming future dividends never change. So first of all, we need to know the discount rate. And the discount rate is going to be the summation of the risk-free rate and the risk premium. So 1.5% plus 2% equals 3.5%. And second, we can use the zero growth dividend formula, which is simple. You see in the upper right-hand corner right here. And so that makes it 2.04 divided by the discount rate, 3.5%, and that gives us $58.29. So the second one is the constant growth dividend model. We're going to use the same information as before for Walmart, but this time we're going to assume dividends are going to grow at a slow, constant rate of 1% per year. So year 1 will be, the dividend will be $2.04, $2.04. Year 2 will be $2.12, etc. So now the challenge is compute Walmart's stock price with this 1% dividend growth rate. So we can use the formula for the constant growth model, which again is relatively simple. You see it right here. All we need is a dividend in the first period, the discount rate, and the growth rate. And we have all of those, so we just plug them into the formula. So D1, dividend paid during year 1 is 2.04, divided by the discount rate, which is 3.5 minus the growth rate, which is 1%. So 2.04 divided by 0.025 gives us $81.60. So if we observe that Walmart's actual stock price is $88, which model is more accurate? The zero growth dividend model or the constant growth dividend model? Well, remember the zero growth dividend model, the stock price came to be $58. The constant growth stock price came to be $81.60. So we'd say that the constant growth dividend model is more accurate in this case. Also, if you want to get specific about the growth rate, you can back out what the implied growth rate is by filling in for P here $88 and leaving G as an unknown and solving for it. So next we'll talk about an example for the variable growth dividend model, which is a bit more complex. That you can see here, it's kind of a beast of a formula, but it's easier if you understand its individual components, right? So in this example, we're going to assume that dividends grow at some rate during some initial period, and then it grows at another rate subsequently after that. So this example is Nike, and we're going to say that Nike currently pays a dividend, D0, of 72 cents per share. Over the next 3 years, Nike is expected to increase its dividend by 10% per year, which gives us our G1. And then afterwards, Nike will reduce that growth rate to 5% per year indefinitely, so that gives us G2. If Nike's required return is 7%, compute Nike's stock price. So ultimately what we're going to do is follow this giant formula here, but we're going to do it piece by piece. So first, we'll focus on the initial growth period. And essentially what you can see here is it's a summation of the present value of dividends during this initial growth period. So we know that N in this example is 3, so the initial growth period only lasts 3 years. So here's the setup. D0, which we know, is 72 cents. We can compute D1, D2, and D3, which is dividends in year 1, 2, and 3, simply by multiplying it by this rate right here. So 1.10 comes from the 10% growth rate during the initial growth period. So we get dividends for years 1, 2, and 3 as being 79 cents, 87 cents, and then 96 cents. Compute the present value of these, which is just dividing by 1.07, where 7% was the required return, and we get these values right here. So the total value during the initial growth period is the summation of the present value of these dividends received over the initial period, which we find to be $2.28. So the idea here is, we've estimated what the future dividends will be at this 10% growth rate, but then we have to discount them back to present value at the 7% required return. And that's what we've done here. So now we're done with the initial growth period. We can move on to the subsequent growth period. And in this case, the dividends last indefinitely. So that makes it nice because we can now use the constant growth model, right? And so the G2, which is the growth rate during the subsequent growth period, is only 5%. So we go back to this formula, and now we move on to solving this. The first thing that we're going to do is focus on this constant growth formula, which gives us the present value of future dividends up to time n, and then we discount that value from time n to time 0. Right? So this part is the discounting part, and this part is the constant growth part. So, well, first of all, what you realize here is that we need the dividend payment for n plus 1. So that means we have to have the dividend for dn and then multiply it by the growth rate of the subsequent period G2. So we go back to here and we can see that D3, which is n equals 3, right, is 0.96. So we multiply 0.96 by 1.05, where 5% is the growth rate in the second, is G2, right, in the subsequent period. And then we divide by the required return minus the growth rate in the subsequent period. So 7% minus 5%. That gives us a total of $50.40. But remember, this value is in time in terms, which is t equals 3 terms. And we need it to be in time 0 terms, or the present. So in order to do that, we take this $50.40 and divide it by 1.07 to the third, where 7 represents our required return. And that gives us $41.14. So this value right here, the $41, represents the total value in this subsequent growth period. So to find the total value of the equity or the stock price, we have to sum up the two growth periods. So that's $2.82 plus $41.14, and that gives us $43.96. And then we're done. Okay, the last example is a free cash flow model. So in this case, I grabbed some financial information about Nike, and now we're going to compute the value of equity using the free cash flow model. So basically, in this past year, Nike generated $3.64 billion in free cash flows to the firm. And we're going to assume that that number is expected to grow at a relatively modest rate of 3% per year. So our G is going to be 0.03. And also Nike has $3.47 billion in long-term debt. So we're going to say that we're going to assume the the market value of debt is the same as the face value of debt in this case, $3.47 billion. And let's say the overall cost of capital for Nike is 7%. So the challenge here is to compute the total value of equity for Nike. So the first thing we're going to do is compute the total value of the firm using the free cash flows to the firm, right? And we're going to use a constant growth model, which means that we need the free cash flow not in time 0, but in time 1. So we multiply 3.64 by the growth rate, 1.03, and that gives us free cash flow in time 1. And then divide by the required return, or the cost of capital, 7% minus the growth rate, 3%. And that gives us a total value of $93.73. So this value represents the value of the firm. So now we have to subtract out the value of debt. In this case, we're also assuming that there is no preferred stock, or else we would subtract that out too. So the value of equity then becomes $93.73 minus 3.47, which is the market value of debt, and that gives us $90.26 billion as being the value of equity.